Hi, everybody. Welcome to another episode of 21st Capital. Today is Friday, March 14th, and Bitcoin is recovering very well from the lows of the recent crash, and market is looking pretty good. So today we have Crypto Wizard again with us to discuss market and update you guys on where we are and where we are going. Hi, Z. How are you?
Doing great. Can't wait to get to the data and just show some charts.
Yeah. So one quick update about our Bitcoin intelligence platform. If you guys were on our wait list, you should have received an update which finally announces the live date, which is going to be this Monday. So we are going live this Monday. This will be a full analytics platform called Bitcoin Intelligence, and you will have access to our charts, our proprietary models for valuation of Bitcoin, and gradually we'll be adding more charts, plus a weekly report, which is going to be called Bitcoin Intelligence Report, and video analyses. A part of it will be free, and then a second part will be paid for people who want to dive deeper into the data. And we are really, really excited to start the work on Friday and give everyone access to what we have built. So definitely follow us to get updates about how to access the platform. Also, over the weekend, we probably do a couple more live events to explain the product and so on. But basically, you're getting the best of analyses from people who have spent a lot of time in Bitcoin and also a lot of time on a weekly basis to track macroeconomics, on-chain developments, derivatives markets, and blend it all together using tools such as econometrics and machine learnings and so on to arrive at useful insights. So tune in for that. The other thing I'll mention is that last week, Z and I were here. We were analyzing the market and the on-chain data mostly. And I would mention that Z again had the correct calls. He was mentioning the potential bearish signals in the market. We were looking at the possibilities of further corrections and the numbers we might go down to, and the fact that there was still risk in the market. Pretty much after that, the market crashed and we went down. What was the maximum low? What's the lowest numbers we touched? I think it was probably
76. I think 76, maybe. Yeah.
Yes. So after that call, I was still watching the market for positive, any sign of reversal. And if you have followed my prior videos on the channel, you'll know that I have been developing this V-shaped recovery, V-shaped economy thesis, where I recognize, from last year, I've said that tariffs will crash the markets. A lot of people didn't believe it. They kind of thought Trump can reverse economic theory. Surprise, surprise, he couldn't. And tariffs did exactly what you'd expect, cause some pockets of inflation. Then because of that, it crashes the markets, and overall balance of risks shifts toward recession. So then you will see inflation coming down, but then growth slowing. At that point, because it's all kind of a manufactured crash, they'll be able to come in and cut the rates and also make deals on tariffs and and pursue the the tax cuts and all the other bullish policies. So the market will recover pretty fast. So I've been looking at these signs of, where we might have enough selling in the market that shows some exhaustion of the sell pressure. So one thing I looked at was, let me show you the screen. I was carefully watching this metric, the net unrealized profit and loss metric, entity adjusted, and short-term holder version of it. So essentially looking at how much profit the short-term holders are sitting at. And I was following this orange curve is that metric, and black is the price. And if you look at it, last week we reached very, very low numbers on profitability of short-term holders. Again, these are people who have bought in the last 6 months. So the NUPEL metric dropped massively to negative 12%. And this compares to negative 14, which we saw last year at the real bottom of the price movement, the price channel, which was happening in late July and August, late summer, basically. So this metric was telling me that, from the time, from the Trump pump up to now, these short-term holders have gone from being 20% in profit to 12% in loss. And that historically is a significant amount, except for the bear market. 10, 12, 14% loss during a bull market is massive for short-term holders. So I thought this is a good place to come in, even if it's not the perfect bottom, it's very close. And that was at 78,000. And I put out a bunch of trades, bought a lot of Bitcoin. I actually have been buying throughout. My thesis is you DCA throughout the correction, right? So you don't try to pick the bottom. But the more convicted I am about being close to the bottom, I could just add more trades. So I did a bunch of things, and essentially we went down 2,000 lower, and then we've been recovering since then. Pretty good signal, very, very powerful signal, which Z and I have been analyzing this for a long time, and we'll just keep watching relevant signals like this in the future. So a couple good useful analysis that Z and I have been looking at lately, and we'll see. I mean, I don't have much hopes for too much of a rally yet, because the macro backdrop is still very weak. We are still waiting to see what happens with growth. Inflation has cooled down a little bit. Core PCE, CPI, and core CPI, they have all cooled down a little bit. They're still high. They're still above the Fed target, but they've shown just this last reading was cool. However, GDP is slowing from 3.1 in Q3 to 2.6 in Q4 last year, and we haven't seen the latest number for this quarter yet, but we did have a slowdown towards the end of last year. So, and with everything with tariffs and all, my guess is the next reading on the economy would be a little bit weak. So that will initially terrify people, but then amplify rate cut expectations. So we'll see how that goes, but let's dive in to some of the data. Before moving into Z's report, I'll show you just a couple more charts. You've seen this many times. These are our some of our valuation models. Looking at the Power Law trend, you see that the prices is still playing around with this trend, kind of hovering up and down around it. This serves as a nice center for the data. If you look closer, we see that our Power Law trend line is at 91%, 91,000. if there was no bubble in the price action, and if you tracked it over the whole history, this would suggest a price of 91K. So we are under that price. We can still go further down, but this acts as an anchor. Very likely that we will get back to this level at some point. And our VPLI metric also shows a reading of 47, neutral valuation again. There doesn't seem to be any sign of bubble in the price action. If anything, we are exactly in the range that historical trend would suggest. And lastly, our quantile model shows essentially quantifies where we are in a potential price channel, which would be 52% at the price of 85. So if bull market continues, by the end of this year, we should see prices like 166 or 200. If historical pattern continues, we'll go to that range, and above 200K to 300K would be the real danger zone. I wouldn't expect anything sustainable above it, and I would actually expect reversal from these points. But also remember that cycles can decide not to repeat, right? But if they do repeat, these would be the prices we'll see. And but at this point, a risk score of 52% essentially puts us at median. Again, says that we are kind of right at the fair valuation, and if any kind of bubble begins to show, we haven't seen any of the effect yet, so it hasn't even started. So pretty nice place to invest. Again, I like gradual dollar cost averaging, but you can adjust the quantities depending on how low we go. For example, like here, I was watching the market here, and I think at 92, I started purchasing. I never bought anything at above 100, and I don't think I've bought anything above 92 as far as I can remember. But at 92, we had a big crash, so I started buying. And then the further we went down, I started buying more. And at 78, I bought the biggest amount. And now I'm just holding and waiting to see what happens, if the recovery is real or not. And we'll just keep watching the market. But for the long run, for the long-term buyer, risk is very, very low. All right. So that's our valuation review. And then let's move on to the on-chain analysis by Crypto Wizard. Over to you, sir. All
right. Yeah, that was like a good opening, Sina. Like going to that range was, if we didn't have like a negative sentiment in macroeconomy, I would actually call it with much more certainty, say, okay, it looks like a local bottom. But as I'm gonna lay it out today, there are chances that yes, we might see a midterm. There is a possibility, and in the perfect world, we had enough capitulation to see a bottom in and start to rally back. But there are a couple of concepts that I like people to consider, to just have, because it's a world of probabilities. Like, yes, I might be 100% wrong, but it's going to be in hindsight when we judge what we say today. So I'm going to lay out what I think is the structure of market at the moment. Like, I'm going to show there is a chance that we see a recovery, but in absence of a positive macro sentiment, it's most likely not sustainable, given that we already saw two waves of distribution, one in early 2024 to 70,000, 70 something, then another rally to 105. If we consider two events separately, we saw the long-term investors already distributed around above 1 million coin each time. So we have to consider we are after two waves of spending by the long-term holder, and we are seeing a lot of uncertainty in macro economy. So given that we are past or post an all-time high, yeah, a recovery is possible, but in absence of a catalyst, I'm gonna stay a little bit bear. But forgive me, people, like I'm trying to just give equal weight to what I see, and then I leave it.
No, every week you come in with warning signs, and we don't want to listen. But right after that, market
Mhm.
shows that you were right.
I always just say, I hope I'm wrong. So people, I hope I'm wrong, but let's see what's going on, and I leave it to the audiences and you, see, not to just like literally make a decision. What I say all the time, having more data is going to give you the chance to be less biased. That's my goal, and I'm pretty sure it's this goal, the same goal you're following. I'm going to use most of the charts that I used. We used recently in Week on Chain on Glassnode. So whoever wants to see the details can go to the Glassnode inside.glassnode.com and read the report. But I'm going to briefly just show what's happening. So the first chart I'm going to show. Let me see if it's the zoom is. Can you see Sina? Sina, is it the zoom good enough? Yeah, I think it should be good.
It's
Yeah.
yes, pretty good.
This the first chart that is I'm showing here is the accumulation trend score, which is literally looking at the different cohort of the investors. I mean by size, different sizes, and looks at their accumulation relative to last 30 or 90 days. I'm not sure about the rolling window, but it's looking at the sentiment among the investors and is measuring if they are accumulating or spending. So it's literally a metric that measuring the sentiment across the market, but it gives more weight to the larger entities. As you can see, all the way to 108, 109, we had a strong accumulation, similar to what we had in late 2019 and late 2020 and early 2021, or what we had in almost from December 2024 all the way to March and April. So that's very normal. Like throughout the rally, we have a strong accumulation, but after seeing an all-time high, when market realizes the demand side is probably exhausted, the price is going sideways, we got rejected for one time or twice by a new all-time high, you could see market understandably enters a phase of distribution. That's what we experienced. I mean, in probably early January or late December, and that's why the second rally to 105 was not strong enough to break above 105 because we were entering a distribution post all-time high distribution, and all the way to 76 we are still in relatively strong distribution. So that explains the weakness in the price action and the downward pressure on the price. So this is just the general idea, like what happened. We're not saying you could have predicted, but it's just explaining it. But we can actually zoom in and see what happened at every price. So if we look at just zoom in and what happened throughout the rally after we see the all-time high, when the price was corrected by from 108 to 109 almost, and we had the first correction mid-December all the way to early January. You could see more investors because this chart is showing the accumulation. If you see a color getting warmer and warmer from a cold color, it is showing in that price investors are starting to accumulate. And this chart is not weighted by the larger entities, so it doesn't give any weight to specific cohorts of investors. So it's looking at the general market, no matter what size is the accumulating wallets. As you can see, throughout the first correction, uh, market was actually accumulating some coin, and this is literally uh, the confidence in the continuation of the rally. Like people say, hey, this was a correction. You could see even in Twitter, they talk, oh, it was a correction. We might go back, buy the dip. You could see they started to accumulate. But after we saw the second correction with 105, we had even stronger accumulation. Remember, people, we were talking about, like audiences, I want to remember, we were getting closer to Trump administration, talk about SBR. So you could see literally at around 95 to 98, people accumulated strongly. So in a normal situation, market should have keep going up because we had to buy the dip that everyone talked about. But after SBR, just the policy about SBR got released, like budget neutral Bitcoin, and also remember 2 weeks ago we talked about liquidity leaving the market. The market in general, especially the meme coins, were draining the market. You could see the liquidity being extracted from market, and we were almost in a negative or close to negative sentiment, the SBR and the Bybit hack was literally the last push that market needed to just go through a correction phase, even though we had some accumulation here. The thing that changed this time is when we entered, when we crashed between 95, throughout this dip or to 78, you are not seeing enough accumulation. The first dip, like normally we should see buy the dip behavior like this to be able to talk about okay bounce back, but like you can see here, it didn't trigger investor to buy strongly
Yeah.
like what we
Yeah, let me
saw.
add something here. This is very interesting, right? Like initially, people thought it's a buy the dip opportunity, but as the price crashed further, they don't. But I'm gonna venture that they just can't because money is leaving the markets everywhere. All the markets are crashing, and we're actually seeing ETFs have begun to sell by a large amount, but also the whole financial market in the United States, including bonds, including stocks, they are weak, but European and global markets are not that weak. So essentially, when you look at the data, it's clear that money is leaving the US towards international markets. And that's why, big pockets don't exist. Maybe hedge funds, maybe other major investors, they don't have that much money anymore, even if they want to buy.
Yeah, yeah. And I mean, if you go, actually, don't have the chart here. If you go and take the main indices of different countries, like Canadian stock market or German stock market, like major, I mean, I think European countries like Germany and a couple of them, if you take them and uh, show the chart versus S&P, you could see we are seeing a bounce back. Like, I don't know, I don't have enough information to say so, but it looks like they're selling their US asset probably to pay their debt back, or they see the opportunity to cash. I don't know. I don't know what's the mechanics, but you could see some capital rotation towards other parallel markets, like especially I just check Canada. I'm pretty sure Germany has better
Right.
uh, performance considered to compared to S&P in last 2 or 3 months. So you could see the capital moving out to other markets, and that's probably one of the reasons you could the macro economy is a little bit like showing some doomsday sign. I don't know what's going to happen, but that definitely is affecting the capital inflow to Bitcoin, like one of the factors. And uh, so what we just okay, we did not have that buy the dip. Like you said, it might be people not having enough cash. Maybe they already spent it at the first crash or first correction in December, early January, and again at 95, 98. This metric is show this phenomena from different angle. You could see two traces, like an orange and a red one. So this is showing the cost basis of the two specific subcohorts of new investors. The orange one is showing the 1 week to 1 month, and the red one is showing the 1 month to 3 month. Why are these realized prices are important? Because this is the cost basis of the new investors, specifically very recent investors. And when the cost basis is following the price during the rally and going up, that means they have the confidence. They are adding new coins to their bag, and their cost basis is following the price. As soon as market shows a little bit weakness, they start to realize loss, and again follow the spot price, and their cost basis start to decline with the price. So this is literally showing the sentiment among two very recent subcohort of investors. And why we're showing them against each other? Because when the younger cohort, like which is 1 week to 1 month, the cost basis drops below the 1 month to 3 month, which is a little bit older cohorts. That is in a strong indication. An early is a canary in tunnel, probably is an early sign that the new investors are losing the momentum. The demand side got exhausted, or it's been spooked. Look at what happened in this cycle. For the majority of the cycle, the cost basis of the younger subcohort, which is 1 week to 1 month, stayed above. And as soon as it broke below the 1 month to 3 month, we had a weakness in the market. Sometimes we had some sort of like touching each other, touching the older cohorts, and the market start to bounce back. So this is a very strong indicator. And all the way in May, again in July, and also in August, all the bear phases was actually could have actually be not predicted, but the probability was high after this younger cohorts cost basis breaking below the older cost basis of new investors. And look what happened in January. The cost basis was just dropping closer to the 1 month, 3 month, but it bounced back because of that buy the dip. So the momentum had a pause temporarily, then again just bounced back because we're getting closer to the new administration getting to office. SBR was literally making incentivizing people to buy again. But as soon as the momentum was lost after the Bybit hack and the SBR policy been released, and people got they got hit by the reality, you could see the demand was literally leaving the market. And the date or the point that this cost basis dropped below the 1 month and 3 month, it was February 23rd, 24th, when price was 90,000. So that was a sign the momentum is gone, at least for midterm. And now we are leaving that world, a lack of enough liquidity introduced to market by the new investors. So this is a very strong indicator that I use often, and you could see it's confirming the fact that we didn't have that capital we needed to have a bounce back. So let me just wrap this up. So far we proved or showed that the demand that we needed for bounce back, a strong V-shaped bounce back, was not in the market for different reasons. And this metric is especially showing the new investors are not passionate, or they don't have confidence in price after a long bull market. We have to see if the 1 week to 1 month realized price bounce back above the red line, which is the 1 month to 3 month, a little bit older sub cohorts of new investors. That is an early sign. Okay, we have a momentum. We might see like what we saw after China ban. See, the orange line broke above the red line, which is showing the momentum is back, and we had a rally in the market. So here we can have this conclusion: the demand that we needed to have to see a bounce back was not in the market. New investor was spooked by the macro, or we can speculate about the reason, but looking at the correlation between the time that this momentum was lost and the external events, you could see the Bybit and negative sentiment in the US market was definitely a big player. Now we want to give people a tool to measure the fear in the market. Yes, we had a correction. Some people are comparing it to a post FTX crash. Some are comparing it with the small correction in 2015, 2016. So we have to have a metric to measure that fear. Not that is very like measurable by math, but we have a really strong set of strong on-chain metrics that helps us to at least try to estimate or compare the current correction or capitulation, the fear that new investors specifically have, to incidents in the market that resembles the same structure. So I would like to just show this chart and explain it well, but I'm just going to be brief and try to just give the update on this metric. And if people are interested, like I said, they can go read the details in the Recon chain, the report we put out weekly on Glassnode. So if you look at the metrics that we have to measure the fear, the most useful one, I mean, it is primitive and it's simple in concept, but it's really useful. It's SOPAR. And I'm sure, Sina, you talked about it, but to just give some explanation to new audiences, SOPAR is literally looking at the spending price, or the price that the new investors or short-term holder are spending at, compared to as a ratio to their cost basis when they acquired that coin, when they bought it. Let's say if I'm spending the coin today at 90,000 and I bought it at 50,000 or 45,000, my SOPAR, my personal SOPAR, the UTXO that I'm spending, is going to be 2. But this is an aggregation of SOPAR among all investors, and just literally focusing and filtering out the long-term investor, just looking at
basically whether people are selling at a profit or at a loss.
Exactly. So if it's by aggregate, this metric is above 1, that means the majority or the aggregate behavior of the short-term holder spending by the new investor have been in profit. If it's below 1, it is loss. But this is looking at just the profit margin being realized by spending. We have another strong and quite undervalued metric that usually like the new audiences on chain world probably like uh, feel like they feel challenged when they want to get their head around, like they don't understand it. Even me myself took me even a year. Still I might not understand it fully, but it took me a year to use it properly. It's CDD. So CD is coin days destroyed. The name is a little bit long, but believe me, it's really strong. This metric looks at the number of days you are spending by spending a coin. Because like I said, so far looks at the profit. If I'm spending, let's say me and Sina buy a Bitcoin. I buy at 40,000 last year. Sina buys it at 40,000 2 years ago. And both of us today spend that coin at 90 or 80,000. So the SOPR for both of us is going to be 2. But Sina waited longer than me. He waited 2 years. Z waited only 1 year. So there should be a metric to track that time being released by Sina's coin and my coin. There should be a difference. And obviously, the coin that had been waited longer should release more time when spent. So this CDD is looking at exactly the number of days that coins were spent today are releasing. Let's say one coin waiting 200 days. As soon as it's been spent, that's going to release 200 coin days. 200 coin waited for 1 day, then spent again. One coin multiple 200, they're going to release 200 coin days the day they are spent. So that's a multiplication, a product of the size of the coins and their waiting time. And when we measure this metric, we're seeing the people who waited longer, the people who were like in the market longer than other investors from the same cohort are now spending. This CDD version specifically look at the short-term holder. So when this metric is going up, that means the recent investors who were on the verge of becoming a long-term holder, so they were like short-term holder, but they were holding it for 1 month, 2 months, very close to this 6-month threshold, 155 threshold to become a long-term holder. For some reason, they start to spend, and they're releasing a lot of time. That's what the spike in this metric means. So it could be throughout a rally when market is positive and they're spending in profit, or it could be like the recent during the recent correction. It could be during a capitulation. They're releasing a lot of time by waiting and spending in loss. So combining these two metrics, SOPR, which measures the amount of profit, and CDD, which measures the amount of time being spent at a specific event, we can actually create a metric. I named it like SOPR adjusted CDD, means we are looking at the CDD. Sorry, we're looking at the SOPR. Let's see, yes, but the SOPR doesn't take into account the time being released. So we are creating a combination of these two metrics to measure both SOPR and CDD, which is the product of the CDD, short-term holder CDD multiplied by SOPR. So right now, when we see the CDD going up and the SOPR is positive, above 1, sorry, you could see the CDD jumped in profit. So they were spending in profit. A lot of time, a lot of waiting time was released. Coinbase was released and destroyed during profitability. When the CDD being like having a spike while the SOPR is below 1, so we have a negative profitability, this metric is showing a negative peak on a spike. The recent crash to 80, almost like 80, 76, it's comparable with the same fear or same kind of behavior, magnitude of fear that we experienced in August 2024 when market, I think, dropped to 49, below 50,000. So we can compare the amount of fear. But when you zoom back and look at, for example, the FTX or Luna or China ban, the capitulation or the size of the loss being realized, time being released in time of pain is not comparable. So that might imply the fact that a lot of people might expect that crash, that event happen again, which is wrong. We cannot say, hey, we have not seen that amount of pain, we should wait for it and we might see that pain. No, we might not see any macro event to push price down. But if it does happen, that is a great opportunity for people who always say it in word that I save money to buy in fear, in bloody days. This recent crash to 86 was one of those, sorry, 78, 76 was one of those bloody days. This metric helps you to spot those bloody days, but seeing one or two bloody days doesn't mean it's going to be end of it. Or if we saw a small spike compared to FTX and Luna crash, is not going to guarantee you're going to see, oh wait, we're going to see another crash. But if that happened, and we didn't have much of it this cycle. If you look at the previous cycles, this is pretty, like, let me go back to 2000. Look, we had a lot of long period of the fear, and look at the COVID time. So this cycle we have not that, I mean, extreme uh, moment of fear in the market, but we never know. Maybe the new institution buyers are one of the reasons that we might not see that downward volatility, excitement in the market, capitulation. It's very well possible. But the outcome of this metric is just saying that crash to 70 was equal pain to 49 in August. We have to see what happens. And I think this metric is going to help you to measure the amount of
So
fear.
So basically, when it's really low and negative, it means people are selling at a loss, but a lot of those losses are relatively older coins that the short-term holders have been holding.
Exactly.
Now, I was thinking maybe because, just as a little note, because you're already taking into account the time held, maybe it would also be interesting to look at the aggregate, not just short-term holders, like everyone.
Yeah.
Yeah, because
Definitely.
then, yeah, because we know that, the action by long-term holders is I mean, a lot less impactful. A lot of the trading happens by short-term holders, so they already will have a lower effect. But if long-term holders begin selling, that will be very well captured here as a larger metric. So
Yeah. And
that would be
that brings me back to the point I made. Seeing that much fear and capitulation in the market in a perfect world would have been an opportunity, and it would increase the probability of seeing a bounce back. I don't know to what price, because we saw the fear, the people who bought at the top, the ones who were probably, I mean, sensitive to price, already spend their coins, and usually it should translate to the seller exhaustion. But like I said, we have another factor, a bigger factor, and that's the external event that is affecting the market. So if it was just Bitcoin and no other market, I would say, hey, this is probably a bottom, at least a midterm bottom in the market. And hey, we might see some positive. As soon as we see some catalyst in macro, I expect this price is ready to go back. But if, because already liquidity is just left the market, I think we need longer positive period of positive sentiment in the macro and other markets to call for a long bull market. So yeah, I'm still a bit bear, but just don't take me serious when you have a different I mean, assessment of the market. I'm just trying to share what I think is the uh, proper way to look at the market. The other thing I'm using constantly is the cost basis of the new investors, which is around, like, the blue line is around 92,000, and one standard deviation above and below. This standard deviation is over the typical deviation that we see from the cost basis of short-term holder throughout different cycles. Like if I zoom back, I mean, look at what happened in 2021, 2022. As soon as we break below in it for a meaningful time, we had to spend almost 2 years to have enough confidence in the market to break above. Right now, we broke below. We are below 92, and it's very similar to what we saw in mid 2024. The best scenario would be going sideways, stay between almost 71,000 and 92, like what we saw back in 2024. And this could be a very strong demand zone, and we see a bounce back in longer term. But for me, like I said, kidney line, or the line that I would spend, like the cash that I was waiting to lump sum into the Bitcoin, would be probably around 70 something. And that 70,000 is very close to cost basis of, I think, MicroStrategy. I think they are around 66 at the moment, the cost basis. And ETFs, cost basis is around 70,000. So all of these cost basis lines and one standard deviation below the cost basis of short-term holder, they have a strong confluence. So 70,000, if we see, I don't say that we're not gonna go below, but it's gonna be a very, very low risk, or low risk is gonna confuse people. Probably a good point, a fair price for Bitcoin for long term. Let's see if we see it. Actually, I'm not sure, but I'm waiting. I'm hoping. I'm a hopeful bear these days. So let's see what happens.
Let me mention something like just a little bit of a, because people have been asking me about a more options commentary. One of the interesting things one can do is one once you have this analysis and you realize that, like, if the price reaches 71, you'll be a buyer. Okay, you have your analysis and you realize 71 is a price that I will buy no matter what. So even if I think it might go lower, you still feel 71 is a fair price. Assuming that one can short the put options with a strike price of 71. What does that do? Essentially, that will keep your cash and get premium from someone else. So you reserve some cash, you get a premium as a gift, just to guarantee that you will buy the coins at that price of 71 if the price goes down there from someone else. So essentially, you give someone else the guarantee that, hey, if price goes down to 71, I'm going to be the buyer, and here is the reserved cash for it, right? So you give the guarantee, you give the insurance to them, they give you a premium, and you enjoy that. If the price actually does go down there, it might look like you're losing money, but you're just buying the coin at the price that you liked. So if it goes below 71, you'll be assigned. So you'll be now purchasing that much Bitcoin or whatever instrument you have. Maybe you're trading with the ETFs and so on. So you will get assigned at that price. Now, even if Bitcoin goes a little bit lower than that, you're still happy because you bought way less than where you put out a trade. So today is at 85. You could put a trade at 71 and keep the premium. So that premium helps you dampen the negative effect of correction. So everyone else just suffers through the correction, but because you're selling short puts, you'll keep collecting premium, and the correction seems a little bit softer to you. And plus, you're ready to buy at those lower prices. Just one of the advantages that options give us, especially with the ETF options that now we have access to.
And I think, the options are pretty cheap. I was looking at the volatility spread, like the implied volatility and realize the spread is pretty low. If we just consider the recent market weaknesses, like it's pretty low. That's the metric they use to see what is the possible, almost a good metric to see how expensive are the option contracts. And the other thing I saw, the skew, the 25 delta skew for like next month, is actually very close to the recent tops that we had since 2024, which is, I think, correct me if I'm wrong, when the 25 delta skew is going up, means the demand for the put or hedging is a little bit higher than the calls. That means that people are hedging, the demand for hedge is high. So it's understandably is a good opportunity if it have a little bit correction for people who want to be directionally actually betting on the upside. What do you think? Like, do you think that the strategy would be, because it's going to be extremely cheap to buy a call?
What I do is I put on long bullish trades for like 1 year out. Right now, maybe not 1 year, maybe up to January. But to reduce the cost of that, I constantly sell calls and shorts. So I sell calls and puts. I short both of them because, let's say you're long call for January.
Yeah.
And it's expensive. Every day
not January. You mean for next month? January next year.
next year. Yeah.
Okay.
So you have a very long-term long option position.
Yeah.
But the thing is, that has a negative carry, meaning every day that passes, the value of that option goes down. So you're losing money. But if you're right and price reaches that level and goes up, you will massively enter profits, right?
Sure.
So what I do is I then sell short-term calls and short-term puts to nullify that daily decay. Okay, why is that?
Mhm.
What does it make sense? Um, Actually, maybe I can show the screen because I wrote about it a little bit, and maybe it's easier. This is exactly, I've actually explained my logic here. The reason you sell the calls is so you have a short-term call that you've sold. Essentially, you're betting that price is very unlikely to reach super high levels in a short amount of time. Okay. And you're getting a lot of premium, a lot of reward. You're collecting a lot of reward for giving this assurance to somebody, right? The thing is, if the price actually does go that much and kind of surprises you, you're going to lose money on this one, but you still have a super long position, maybe through your main spot exposure or through the other long call options, that if the price suddenly goes to 200, you're going to lose on this one, but you're going to gain a lot on the other position. So it's not a horrible place. Plus, your main Bitcoin stack has now gone up massively. So you have nothing to complain about. Plus, you've
That's
collected
what
the
I was
premium.
about to say. So, like I think it should be extremely short term if you want to do that, sell calls, and also cover a call by being long in the spot. I mean,
Exactly. It has to be
you.
always covered. Always
Yeah,
go
yeah.
covered because
So
options can quickly turn against.
you got, especially if you sell a call. I'm not really knowledgeable, but I think if you sell a call and I don't know, the orange man come and say, "Hey, we're gonna buy 1,000 coins per week," you're gonna be
Yeah,
sorry.
but
But
after a while,
short term is nice. Yeah,
after a while, you know that over 1 week you were not going to have a 30,000, 20,000 change in the price or something.
exactly.
But you will hear that from influencers. So,
Yes.
and I'm like, every time I see a super popular tweet about, oh, we're gonna get to 250 next week, I sell more calls. So, and I make some money off of it. But just to complete that thought, the other side of that trade is you can also sell puts. But again, these have different risk profiles. When you're selling a put, you're first of all, you're locking up cash, so there's an opportunity cost. If Bitcoin flies, your cash is now unused. So this works best if you really want to keep that cash on the side.
Mhm.
Plus, again, if Bitcoin really flies, I have my main stack, which I'll be happy about. So a little bit of unused cash would be fine to me. And especially I do this when I expect price. I don't really expect massive jumps. But then what this does is it reserves your cash for a purchase at the lower price, but you also get rewarded for it, right? So it's kind of like somebody that keeps some dry powder. A lot of people do that, right? They keep a little bit of cash just for benefiting from opportunities, but you can put that cash to use by selling puts at the right prices so that you're collecting premium while you wait for the correction to happen, right? So that's the general mentality here. But in both
I
cases,
was.
yeah.
Have you heard of like this combination? Because I was trying, because I don't have the mathematical knowledge yet to just combine these two scenarios. But let's say we are somewhere that by on-chain data we're seeing, okay, liquidity is gone for 1 year or 6 months. It's absolute pain in the market. I was thinking like a combination of a short in the futures market, the calendar one. I'm not talking about the perpetual, because perpetual volatility, you might see like a swing in the market and just everything goes away. A rolling the short position in futures and start to buy, call, and roll it again to next month and collect the premium. What do you think? Like, is it going to be good? Like, is it a good idea when we see there's going to be a chance that we enter a bull market? I mean, bull phase.
Yeah, I think that's fantastic, especially because you can just go up, maybe, just roughly speaking, you have to look at it, but say you can determine a strike price of, say, 20,000 above today's price, right?
Uh-huh.
So it's very unlikely for us to go up by that much in 1 week or 2 weeks or whatever. But it's not impossible, right? It may happen. If that happens, you're not losing money. Essentially, you're losing your Bitcoin at a lower price than the final top of the market. But the thing is, this absolutely cannot keep happening. So if you get a huge spike, and maybe one of the several trades you put on ends up being not delivering profit, you can continue that. And then you've just taken a little bit of a profit because of that short call position. Essentially, when you're short a call, if it's a covered call, your main coins are put up for sale at a high price. If price reaches there, you sell your coin. So you take profit, but the bad thing about it is if price goes further up, it's a loss. But the other way to look at it is you've taken some profits on the way up, right? So
True.
General idea is, if you're bullish, have really long dated, own long dated call options, but you can also sell short term calls to dampen the cost of being long, essentially collect some premium over time. Generally, people are too bullish, especially right after price jumps. Like, I made a lot of successful trades. Pretty much 100% of the trades ended up with full profits when we were going up after all the Trump pump. Because once we get to 100, people were talking about 120, 150, 200, and I was just selling calls at 110, 120 every week after week, because I was thinking, the price has to take a pause to absorb all that spike, exactly when all these influencers are pushing everybody, like pushing all those high price targets. So if you have that kind of viewpoint, that it's a little bit less likely for the price to immediately go up, but over long term it will go up. In that case, covered calls are fantastic tools.
Yeah. Like, I hope we see like a nice bottom formation. I really like to follow, because I saw you putting it out in Twitter. I really like to learn about them, and it's interesting. And I can't see why people are interested, because it looks fine. It looks interesting.
Yeah, options are fascinating. They allow you a lot of levers. If you really understand them, it improves your ability to do things, and also it reduces your need to sell your actual coins. So sometimes you can hedge your positions with them, or sometimes you can generate cash flow, right? A lot of people now have tons of Bitcoin, but they don't have cash flow. Several of the clients that we've had at 21st Capital, they have that situation. They're coin rich, but dollar poor. The options allow you to, convert those coins into a constant flow of cash as well. So they're pretty powerful. It's fascinating to learn. And it's also a little bit complicated. You need some math knowledge, which also makes it interesting, because now when you pass that hurdle, you now have an advantage over everybody else. So yeah, it's a pretty good thing for the people to learn. I definitely recommend that. And these days we have fantastic resources on that as well. Okay, so today we want to be a little bit shorter than usual. But is there anything else we want to mention before we close this session, Z?
Sure. No, it was a pleasure. Stay safe, people. Don't risk it. Just stay humble, like you say, and stack sats and watch and learn.
Yes. Stay humble and stack. And this is remember, this is a long game, and slow down. Reduce the amount of information you absorb from, famous influencers and so
Influencers.
on. Yeah.
Influencers.
Yeah. Most of the information we see online is noise. So try to kind of follow. What I do personally is I give people a month or 2 months and see if I'm getting constant signal. Then I keep following them. Then I unfollow everyone else. And don't generally not advisable to change your strategy based on recent price action, right? And it's extremely hard to do. Like when price is crashing, it's very hard not to sell, but that's exactly what you need to do to be successful in the long run. So, but hopefully some of the analysis that we bring to you is going to give you some perspective and give you some calm when the price is crashing, and give you some humility when price is going up too fast. Thanks a lot for being with us. Tune in for our launch of our platform on Monday, and we'll keep in touch.
Sure.
Thanks a lot, everybody.
See you, everyone.
Bye-bye.
Bye.